5.5% of a $1 million portfolio is $55,000 in the first year. Adjust that figure for inflation every year after, nothing more, nothing less. And according to the historical record, that withdrawal schedule has never once run a retiree to zero, not in any market that began since 1926. Sit with that for a moment, because it contradicts almost everything the retirement industry tells you. The number most Americans have absorbed is 4%. 4% is the cautious default, the one financial planners reach for when they want to be safe. 5.5% is nearly 40% more income from the same balance, $55,000 a year instead of $40,000. On $1 million, that gap is $15,000 annually. Over a 30-year retirement, ignoring inflation, it is $450,000 of spending the 4% rule leaves on the table. And yet, on paper, both numbers survived. The backtests that produced the famous 4% rule and the backtests that produced this 5.5% figure draw from the same well of American market history. Same stocks, same bonds, same century of booms, crashes, and inflation shocks. So here is the question this entire investigation exists to answer. If 5.5% genuinely survived every market cohort since 1926, every retiree who started in every year, including the ones who retired into the worst decades of the 20th century, why will no honest analyst hand it to you as a rule? Why does the profession quietly keep recommending 4, while the data sits there suggesting more? The instinct is to assume someone is being timid, or that the planners are protecting themselves. That is the easy story, and it is wrong. The real answer is buried inside the number itself, in the assumptions that make the survival record true. Because a withdrawal rate is not a fact about money. It is the output of a calculation, and every calculation carries hidden inputs. Change one input, and 5.5% stops surviving. Consider what that $55,000 actually depends on. It depends on how long the money has to last. It depends on how much of the portfolio sits in stocks rather than bonds. And it depends, most quietly of all, on what the market was priced at on the day the retiree walked out of the office for the last time. 3 variables, 3 levers. Each one is doing enormous work inside a single, clean-looking percentage. This is what forensic examination of a number looks like. You do not accept the headline. You do not reject it either. You take it apart, name every piece, and watch what happens when each piece is stressed. By the end, the figure will not be 5.5%. It will be a range with conditions attached to every edge of it. But none of that dismantling can begin yet, because the claim itself is not fully defined. A withdrawal rate that survived every market since 1926 sounds precise. It is not. It rests on a single word that sounds obvious and means something far narrower than most people assume. Before that survival record means anything, one word has to be defined: survived. What did the retiree who started with $55,000 a year actually have at the end? A pile of money or a receipt showing the account closed with a single dollar left in it? That question matters more than it sounds, because in the backtest, both count as the same result. Both are labeled success. Here is the mechanism that produces the headline. Take a portfolio. Call it 60% stocks, 40% bonds. Pick a starting year, say 1926. Withdraw 5.5% in year 1. Every following year, add the previous year's inflation to the dollar amount and withdraw that, regardless of what the market did. Then run the clock for 30 years and ask one binary question at the end. Is the balance above 0 or not? Above 0 is a pass. 0 or below is a failure. That is the entire test. Now repeat it. Start the same schedule in 1927, then 1928. Then every single year through the last start date. That leaves a full 30-year window in the data. Each of those runs is a cohort, a hypothetical retiree who happened to walk out the door in that particular year and lived through whatever the market handed them next. Roll the window forward 1 year at a time, and you get dozens of overlapping 30-year lifetimes, each stress tested against real returns, real inflation, real crashes. When analysts say 5.5% survived every cohort since 1926, this is precisely what they mean. Not one of those rolling 30-year windows ended at 0. The account was still breathing at year 30 in every case. That is the claim stated fully. And now look at what the claim quietly refuses to measure. It does not ask how much was left. A cohort that ended with $2 million and a cohort that ended with $800 are recorded identically, both survived. It does not ask what the balance looked like in year 18, when a retiree might have watched the portfolio shrink to a fraction of its starting value with 12 years still to fund. The test has no column for fear. It has no column for the retiree who saw the number cratering and cut their own spending out of terror the model never told them to feel. Survival in this framework means one thing only. The arithmetic never produced a 0 before the 30th year. Not comfort, not confidence, not a dime of margin, just the money outlasted the clock by however thin a thread. This is the trapdoor under the entire headline. A number can pass a survival test and still describe a retirement that was, in real time, a slow-motion emergency. The model exhales at year 30. The human being living inside it may have stopped exhaling years earlier. So the honest next question is not whether 5.5% survived. The record says it did. The question is by how much, and specifically, what was the thinnest thread it ever hung by? Somewhere in that stack of overlapping cohorts, one retiree came closer to 0 than all the others. One start year turned survival from a comfortable outcome into a photo finish. Because if the worst case merely grazed the floor, if some cohort limped to year 30 with almost nothing and no cushion for year 31, then the word survived is carrying far more weight than it can honestly bear. A plan that technically works while feeling like a controlled crash is not the same as a plan that works. Which cohort came closest to 0, and how close is close? Why 1926? Not 1900, not 1871, though usable market data reaches further back than either. The choice is not arbitrary, and it is not sentimental. It marks the point where the record stops being a patchwork and becomes something a backtest can actually stand on. Start with what came before. Reliable, continuous total return data for American stocks and bonds. Dividends reinvested, prices consistent. Indices constructed the same way month after month. Thins out badly the deeper into the 19th century you go. The numbers exist, but they are stitched from different sources, different assumptions, different definitions of what counted as the market. Build a 30-year survival test on that foundation, and you are not measuring history, you are measuring the seams between datasets. 1926 is where the seams disappear. It is the start of the modern machine clean return series that most academic and industry studies treat as the beginning of trustworthy record. The Center for Research in Security Prices, the dataset nearly every serious study leans on, begins its daily record in that year. So when an analyst says since 1926, they are not making a claim about the whole of market history. They are making a claim about the span where the arithmetic can be trusted to the dollar. Now watch what that starting line was chosen to contain. A retiree who began the clock in 1926 walked within 3 years straight into the worst equity collapse in American history. The 1929 crash. The banking failures. A stock market that lost roughly 90% of its value from peak to trough and did not fully recover in nominal terms for a quarter century. That is cohort number 1. The very first 30-year window opens directly onto the Great Depression. Roll the window forward, and the enemies keep changing. The cohort that started in the early 1930s retired into deflation and mass unemployment. The cohort that started in the 1940s funded its retirement through wartime rationing and the inflationary surge that followed. The cohort that started in the mid-1960s, hold that one, walked into something different again. Each start year is a different retiree meeting, a different disaster at a different distance from day one. This is the turning point in how you should read the headline. The phrase survived every cohort since 1926 is not describing one long, forgiving market. It is describing a gauntlet. Dozens of overlapping 30-year lifetimes, each colliding with whatever the calendar happened to place in its path. Depression, war, inflation, stagnation, and the long booms in between. The claim only means something because the starting line was drawn to include the catastrophes, not to dodge them. And here is the consequence most people miss when they hear a survival statistic. The 1926 anchor is doing quiet work in the retiree's favor. A start date in the 1920s means the earliest cohorts got the depression out of the way early, a crash in the first years of retirement, followed by decades of recovery to rebuild the balance. Timing is not neutral. A disaster in year 3 is survivable in a way a disaster in year 25 is not, because the portfolio still has time on its side. Move the starting line, and you move which retirees got their catastrophe early and which got it late. So the record is real. Every one of those overlapping windows cleared the bar. But the bar was cleared inside a very particular arrangement of history, a specific range of start years, a specific length of runway, a specific accident of when each crisis arrived relative to when each retiree stopped working. The gauntlet was survived. That much is true. But a gauntlet is not one threat repeated, it is many threats, each testing a different weakness in the plan. Each of those overlapping cohorts hides a different enemy, and one of them nearly won. One detail has been sitting quietly under every number in this investigation, and it decides everything. The survival record does not belong to, quote, a portfolio. It belongs to one specific portfolio. Change the mix, and the record changes with it. The 5.5% figure assumes a retiree holding 60% stocks and 40% bonds, the broad U.S. equity market on one side, intermediate-term government bonds on the other, rebalanced back to that split every year. That is the machine underneath the claim, not a vault of cash, not a laddered set of treasuries. A portfolio where more than half the money is exposed to the stock market every single day of a 30-year retirement, including the days it is falling. That exposure is not a risk the model tolerates, it is the engine the model depends on. Consider two retirees, same $1 million, same $55,000 first-year withdrawal, same inflation adjustments, same rolling cohorts since 1926. The only difference is the split. The first holds 60% stocks. The second, nervous about volatility, holds 30% stocks and 70% bonds, a mix that feels intuitively safer. Run both through the identical gauntlet. The 60-40 retiree clears every cohort. The 30-70 retiree does not. This is the part that reverses most people's instincts. The more conservative portfolio, the one with less in the scary asset, fails more often at 5.5%, not less. Because bonds, over a 30-year horizon, cannot outrun the combination of inflation and a withdrawal rate this high. The stock allocation is what generates the real growth that refills the account faster than the retiree drains it. Cut the stocks, and you cut the only force capable of keeping pace with $55,000 rising dollars a year for 3 decades. Safety, measured over a long enough clock, becomes the thing that runs you to zero. Now deepen it, because the split does more than pass or fail. It sets the entire shape of the outcome. A portfolio heavy in stocks does not merely survive more often, it survives with wildly different endings. Push the allocation up toward 80% stocks, and the successful cohorts finish enormous. The good markets compound violently on a large equity base, but the worst cohorts finish thinner and travel through deeper, more terrifying drawdowns along the way. Push it down toward 40% stocks and you compress the range. Fewer spectacular endings, but a floor that gives out sooner under a 5.5% draw. The allocation is not a dial for comfort, it is the dial for which risk you are choosing to run. The risk of a stomach-churning ride, or the risk of outliving the money. 60-40 is the compromise that happens to clear the bar. It is not a law of nature. It is a specific point on a curve, chosen because it is the mix where the historical record stays clean at this withdrawal rate. Move 10 points in either direction and the survival guarantee starts to fray. Too few stocks and the money runs short in the hard cohorts. Too many, and the drawdowns grow deep enough that the number technically survives, while the human being holding it very likely would not. So the headline needs a second correction. It was never 5.5% survived every market since 1926. It was 5.5% survived on a 60-40 portfolio rebalanced annually over 30 years. Strip out the allocation and the claim collapses. The percentage was never doing the surviving on its own. The stock-bond split was carrying it the entire way. Which forces the uncomfortable next step. If a 10-point shift in allocation can crack a record that held through the Great Depression, then somewhere in that stack of cohorts there is a single worst case. One retiree, one start year, who took the 60-40 portfolio and the 5.5% draw and came closer to the floor than anyone else. Close enough to name the year. Close enough to measure the thread. 30 years. Every survival number in this investigation has been fenced in by that horizon, and it is worth asking why anyone should accept the fence at all. A retiree walking out the door at 65, in reasonable health, is not planning for 30 years. Many are quietly planning for the possibility of 40. So here is the fair objection, and it deserves its strongest form before it gets dismantled. 30 years, the skeptic says, is a convenient fiction chosen because it flatters the number. It happens to match the rough life expectancy assumptions the original studies used, and it happens to be the window that keeps 5.5% looking survivable. Stretch retirement to what people actually live, the argument goes, and the whole record is exposed as a horizon trick, a survival rate that only survives because the clock was set to stop before the money would have. Take that objection seriously, because half of it is correct. The 30-year window did originate from a specific assumption. The research that produced the 4% rule, William Bengen's 1994 study in the Journal of Financial Planning, modeled a retiree from age 65 to 95. That was not a random choice. It matched the actuarial reasoning of the early 1990s, and every later study that reused the 30-year window, including the ones producing higher rates, inherited it. The horizon is a convention, not a law. The skeptic is right that it was chosen. But being chosen is not the same as being wrong. Here is where the objection breaks down. 30 years is not a fictional stopping point for the average 65-year-old. It is a reasonable central estimate. Social Security's period life tables put the expectation for a 65-year-old man at roughly 18 more years and a woman at roughly 20, with a meaningful tail beyond 90. For most single retirees, a 30-year plan already builds in a cushion past the median. The horizon is not rigged short. It is rigged slightly long, on purpose, to cover the people who outlive the average. The problem is not the 30-year assumption itself. The problem is who it does not cover. Consider a couple, both 60. Not 65, 60, retiring early, as a growing share of financially prepared households now aim to do. Actuarially, the probability that at least one of two 60-year-olds reaches 95 is far higher than the probability that any single 65-year-old does. For that couple, planning to 95 is not a 30-year problem, it is a 35-year problem. Plan to 100, which longevity data no longer treats as fanciful for a healthy couple, and the fence moves to 40 years. And this is where the arithmetic stops being friendly. The withdrawal rate survival test is not linear in time. Each additional year is another year. The portfolio must generate returns faster than a rising withdrawal drains it, and another year exposed to the possibility that a bad market arrives late when there is no runway left to recover. The years added at the end are the most dangerous years, because they remove the one advantage early cohorts had, time on the far side of a crash. A rate that clears every 30-year cohort is making an implicit promise it never states out loud. The promise is that the money only has to last 30 years. Move the fence, and you are no longer testing the same number. You are testing whether 5.5% can carry a portfolio through a decade. The original backtest never asked it to survive. The survival record, in other words, has an expiration built into its own definition. And the modern retiree, younger at retirement, partnered, statistically longer lived, is precisely the person standing on the far side of that expiration. Stretch the fence to 40 years, and the friendly number starts to bite. A retirement portfolio is often pictured as a reservoir, a fixed body of water the retiree draws down bucket by bucket until it empties. That image is wrong in one decisive way. A reservoir only loses water. A 60-40 portfolio funding a 5.5% withdrawal is not a reservoir. It is an engine with a fuel line that runs both directions, burning cash out to the retiree every year while pumping returns back in from the market. And the part of that engine doing the pumping is not the bonds, it is the stocks. Watch the mechanism year by year, because this is where the number lives or dies. In year one, the retiree pulls $55,000 off $1 million. That is 5.5% gone. For the plan to survive, the portfolio has to replace most of that withdrawal before the next one comes due. Bonds, over the long run, have historically returned somewhere in the low single digits after inflation, enough to slow the drain, nowhere near enough to reverse it. Real U.S. equity returns, by contrast, have averaged around 6 to 7% annually across the long record. That gap is the entire game. The stock allocation is the only component of the portfolio that has reliably out-earned a 5.5% draw over a 30-year span. The bonds are ballast. The stocks are combustion. Now hold both facts in view at once, because they are the same fact. The engine that generates returns capable of outrunning the withdrawal is the same engine that can lose 40% of its value in 18 months. There is no version of this portfolio where the growth arrives without the volatility. They are not two features. They are one mechanism seen from two angles. The market does not offer a stock-like return with a bond-like ride. The return is the compensation for the ride. This is why the 60-40 split from the previous examination is not a comfort setting. It is a fuel mixture. 60% in equities is roughly the minimum stock exposure that generates enough combustion to keep a 5.5% withdrawal alive across the hard cohorts, and roughly the maximum that most retirees can hold through a crash without abandoning the plan. The number sits where it sits because it is the point where the engine produces enough power to survive without shaking itself apart. But an engine has a vulnerability a reservoir does not. Timing. A reservoir does not care when the water leaves. An engine cares enormously when it loses power. Consider what happens if the equity portion falls hard in the first years of retirement, while the balance is still near its peak and the retiree is still pulling 55,000 inflation-adjusted dollars regardless. Those withdrawals now come out of a shrinking base, selling shares into a falling market to fund a fixed lifestyle. Every dollar taken during a drawdown is a dollar that can never participate in the recovery. The engine has to climb back not from where it fell, but from a floor the withdrawals kept pushing lower. That is the shape of the danger. The stock allocation is what makes 5.5% mathematically possible over 30 years. No other asset generates the growth to sustain it. And that exact same allocation is what exposes the retiree to the one sequence of events the survival test barely tolerates: a severe equity decline early, while the portfolio is largest and the fixed withdrawals bite deepest. The growth and the fragility are not in tension. They are the same equity dollars, doing both jobs at once. Which means the worst cohort in the entire record will not be the one that met the deepest crash. It will be the one that met its crash at the worst possible moment, early, with the fixed withdrawals draining the base before the engine could recover. The engine that lets you take 5.5% is the same engine that can gut a portfolio in the first 5 years. Two people retire in the same month, on the same day, with the identical $1 million and the identical 60-40 portfolio. They take the same 5.5%, adjust it for the same inflation, hold their nerve through the same headlines. 30 years later, one of them dies with $3 million, and the other spent the last decade watching the balance crawl toward the floor. Nothing about their behavior explains the gap. The gap was set before either of them stopped working, by a number neither of them chose, and most retirees never look at: the price of the stock market on the day they walked out the door. That is the everyday observation hiding in plain sight. People obsess over the withdrawal rate they pick and the allocation they hold. The two levers the last several minutes were spent dismantling. Almost nobody prices the market they happen to retire into. And yet that single condition, fixed by the calendar rather than by any decision, does more to separate the comfortable cohorts from the doomed ones than either lever the retiree actually controls. Here is the insight the data forces. A stock's future return is not a fixed property of the stock. It depends heavily on what you paid to own it. Buy the broad U.S. market when it is cheap relative to earnings and the historical forward returns are strong. Buy it when it is expensive and the forward returns compress, sometimes for a decade or more. Robert Shiller's cyclically adjusted price-to-earnings ratio, the CAPE, which measures price against 10 years of inflation-smoothed earnings, has been the clearest available proxy for this. Research using the CAPE, notably Wade Pfau's work on valuation and safe withdrawal rates, found that starting valuation on the retirement date was one of the strongest predictors of which cohorts thrived and which barely survived. Retire when the market is cheap, and 5.5% is generous. Retire when it is dear, and the same rate is a wager. Expand that, because it reframes the entire survival record. Every one of those overlapping cohorts since 1926 started at a different valuation. The retiree who began in the depths of the early 1930s or in the washed-out markets of the late 1940s was buying future returns at a discount. The engine had a tailwind before it ever fired. The retiree who started near a valuation peak was buying the same withdrawal schedule at a premium, funding $55,000 rising dollars a year from a portfolio priced for disappointment. The survival test treats all of them identically. It asks only whether the balance cleared zero at year 30. It never asks what price of admission each retiree paid, even though that price quietly determined how much cushion they ever had. This is the third lever, and it is the cruelest because it is the one the retiree cannot touch. Horizon is a planning choice. Allocation is a planning choice. Valuation is an accident of birth year and the timing of a career's end. A person does not get to decide that the market will be cheap the month they turn 65. They inherit whatever the market is doing, and that inheritance sets the odds before the first withdrawal is ever taken. So the survival record carries a hidden asterisk. It held across every cohort, but the cohorts were not equally tested because they did not all start at the same price. A cheap starting market forgives a high withdrawal rate. An expensive one punishes it silently, cohort after cohort, without ever tripping the zero the test is watching for. Which is why the honest question is no longer whether 5.5% survived. It is, what was the market priced at when it nearly didn't? Two retirees, same rate, ended decades apart in wealth for one reason set before they retired: the price of stocks on day one. Now name the year that price ran a retiree closest to the edge. 1966. That is the year. Not 1929, not 1973, not the crash years everyone braces for. The retiree who walked out the door in 1966 took 5.5% off a 60-40 portfolio and held the plan for 30 years came closer to zero than any other cohort in the entire record since 1926. And almost nothing about 1966 looked dangerous at the time. Feel the tension in that because it violates the pattern the last several minutes built. The engine's worst enemy was supposed to be an early crash, a violent equity decline in the first years, draining a fixed withdrawal from a shrinking base. But 1966 had no dramatic crash on the retirement date. The Dow was near a high. The market looked calm, even generous. The retiree who started that year began with the market priced expensively and the economy apparently healthy. There was no obvious signal to fear. What arrived instead was slower and more corrosive. The late 1960s and the entire 1970s delivered something the survival test barely tolerates: a long stretch of poor real equity returns married to relentless inflation. Stocks went roughly nowhere in nominal terms for over a decade, while consumer prices more than doubled. That combination is the specific poison this plan cannot easily metabolize. The withdrawal schedule does not care that the market is flat. It climbs with inflation regardless. So the 1966 retiree kept ratcheting the dollar withdrawal upward year after year into a portfolio that was not growing, priced high on day one, bleeding real value from both ends at once. That is why 1966 beat 1929. The Depression retiree got the catastrophe early and then 3 decades of recovery on the far side. The 1966 retiree got no single catastrophe, only a grinding decade with no runway advantage, the drawdown and the inflation working together, the account descending toward the floor with the clock still running. Now the relief, because the record holds even here, the 1966 cohort did not fail. On a 60-40 portfolio over the tested 30 years, 5.5% still cleared zero. Barely. The balance sank to a fraction of where it started, the cushion evaporated, and then the bull market of the 1980s and 1990s arrived just in time to keep the arithmetic above the line at year 30. The worst retiree in 100 years of American markets survived. This is the part that lets the 4% camp and the 5.5% camp both point at the same data. And here is the revelation that closes the case. The 1966 retiree survived on paper and lived in quiet emergency the entire way. Picture the balance in year 15, 1981, with the portfolio a shadow of its starting value, inflation still raging, and 15 years of rising withdrawals still owed. The survival test records that person as a success, identical to a cohort that ended with millions. But no human being watching that account through the late 1970s felt like a success. They felt like someone about to run out of money, because by every honest measure they nearly were. The model exhaled at year 30. The retirees stopped exhaling around 1974. Now move the fence. Everything about 1966 assumed the money only had to last 30 years until 1996. But 1966 to 1996 is exactly the window that ends the moment the rescue rally finishes. Ask the 40-year question and the mercy disappears. A 1966 retiree needing the money to reach 2006 would have carried that gutted, inflation-ravaged portfolio through the entire lost decade and out the other side into the dot-com bust, funding rising withdrawals for 10 more years from a balance. The survival test left with almost nothing at year 30. The thin thread that held to 1996 does not obviously reach 2006. The worst 30-year cohort in the record is the one least equipped to become a 40-year cohort. Stretch its retirement by a decade, and the survivor becomes the casualty. The 1966 cohort was tested with one hand tied behind the model's back and in the retiree's favor. The backtest let that portfolio compound gross returns, paid no fund fees, owed no tax, and stopped the clock at 30 years. Strip those courtesies away and you are no longer looking at 1966's retiree. You are looking at the person watching this, younger, longer lived, and paying the frictions the historical record quietly ignored. Start with the reflection the numbers keep circling back to. Every assumption examined so far, horizon, allocation, valuation, was a condition inside the math. The frictions are different. They are not assumptions. They are the standing costs of being a real investor in a real account. And the survival test omitted every one of them. The historical study withdrew from an index, not from a portfolio a human being can actually own. An index has no expense ratio, no advisory fee, no tax on the shares it sells to fund a withdrawal. The retiree does. Now make it concrete. Take the friendly headline case. $1 million, 60/40, 5.5%, 30 years. That is the index world, and it survives. Now build the same retiree in the world they actually inhabit. Layer on a modest total cost of ownership. Call it 1% a year between fund expenses and advice, which is unremarkable for a mainstream retiree. That single percent does not shave 1% off the ending balance. It compounds against the portfolio every year the money is invested, quietly lifting the effective withdrawal rate. A 5.5% draw sitting on top of a 1% drag behaves, over 30 years, much closer to a 6.5% draw on a costless portfolio. And 6.5% does not survive the 1966 cohort, it fails. Add the second friction the index never paid, taxes. The historical withdrawal is a pre-tax figure. A retiree pulling $55,000 to spend does not get to spend $55,000. Some of it is owed to the IRS. On tax-deferred withdrawals taxed as ordinary income, on realized gains in a taxable account. To fund the same lifestyle net of tax, the gross withdrawal has to be larger, which pushes the effective rate higher still. The number the model calls 5.5% is, for a spending retiree, functionally more. Then the third pressure, the one from the horizon block, standing behind both. That couple retiring at 60, planning to 100, is not asking these frictions to hold for 30 years. They are asking for 40. 40 years for the fees to compound. 40 years of exposure to a late, unrecoverable market. 40 years for a 1966-style grind to arrive with no rescue rally waiting on the far side. Here is the application, and it is uncomfortable precisely because it is monotonic. Take each adjustment the real retiree faces and ask which direction it moves the survivable rate. Longer life, down. Fund and advisory fees, down. Taxes on withdrawals, down. Today's elevated starting valuations, from the valuation examination, down. Not one of these pushes the other way. There is no offsetting friction that quietly raises the number back up. Every honest correction bends the same direction. That is the pattern worth sitting with. The 4% rule was not timid for its own sake. It was a costless, 30-year, index-based figure that some analysts then padded downward for exactly these frictions. The 5.5% claim is the same index figure read optimistically. Both describe the model. Neither describes the account. So the survival record was real, and it was measured in a world the modern retiree does not live in. Once the fees compound, the tax is paid, and the fence moves to 40 years, the question is no longer whether 5.5% survived history. It is what 5.5% quietly becomes in the hands of a person who has to pay to hold it, and every adjustment points the same way, down. Start where the last examination left off, with a number that only moves in one direction. Every honest correction bent the survivable rate downward. So do the arithmetic and see where it lands. Begin with the headline, 5.5%, 60-40, 30 years, no fees, no tax, index returns. That is the number that cleared every cohort since 1926, including 1966 by a thread. It is real. It is also the number nobody actually gets to withdraw, because it was measured in a world with no frictions and a clock that stopped early. Now peel back what it hides, one layer at a time, and watch the figure erode. Take the horizon first. The 30-year test flattered the 1966 retiree by ending in 1996, precisely when the rescue rally finished. Stretch that same retiree to 40 years and the thin thread phrase. Adding a decade to the horizon has historically pulled the survivable starting rate down by roughly half a percentage point to a full point. Call it a move from 5.5 toward something closer to 4.5, before a single dollar of cost is paid. Then layer on the frictions from the previous examination. A 1% total cost of ownership, fund expenses plus advice, unremarkable for a mainstream retiree, does not subtract 1% from the ending balance. It compounds against the portfolio every year, lifting the effective withdrawal rate. On a 30-year plan, it pushes a 5.5 draw to behave like 6.5 on a costless portfolio, and 6.5 fails 1966. Run it the other way to find the survivable figure, and that 1% of drag pulls the safe starting rate down by roughly the same 1% it costs. Add tax. The historical withdrawal is a pre-tax figure. A retiree who needs $55,000 to spend must withdraw more than $55,000 to cover ordinary income tax on deferred accounts and realized gains in taxable ones. That does not change the model's percentage, it changes what the retiree can actually live on, which is the only number that matters. The gross rate required to fund a real net lifestyle sits higher than the headline, which means the safe net rate sits lower. Then the variable no one controls. Starting valuations today, measured by the cyclically adjusted price-to-earnings ratio, sit well above the century-long median. Every cohort that retired into an expensive market bought future returns at a premium and carried a thinner cushion the whole way. FAO's valuation work found starting price was among the strongest predictors of which cohorts thrived and which barely survived. A high valuation start does not guarantee failure. It compresses the safe rate, historically by another half point or so, and it does so silently, without ever tripping the zero the test watches for. Stack them. 30 years becomes 40, down. Costless becomes 1%, down. Pre-tax becomes after-tax, down. Cheap market becomes expensive, down. Not one adjustment offsets another. The corrections are monotonic, and they compound. So what does 5.5% become? For a modern retiree, younger at retirement, partnered, longer lived, paying real costs into an expensive market, the honest range lands somewhere between roughly 3.25% and 4.5%, depending on how many of those frictions apply and how hard. For a healthy couple retiring early into today's valuations, the low end of that range is the prudent read. For a shorter horizon, low costs, and a cheaper entry point, the high end reopens. After fees, taxes, and a longer life, 5.5% does not stay 5.5%. It becomes a range whose edges are set by conditions specific to one person's circumstances, which is the uncomfortable truth the range exposes. The honest number is not 5.5% and not 4%. It is not a number at all, in the fixed sense both camps insist on. It is a rate that moves as the retiree moves, with the horizon, the costs, the valuation, and the year they happen to stop working. Two retirees, same expensive starting market, same 1% in fees, same 40-year horizon. One takes exactly 5.5% every year no matter what the portfolio does. The other takes 5.5% in year one and then does something almost embarrassingly simple. In any year the market falls hard, they skip the inflation raise and trim spending by 10%. Nothing else about them differs. And that single behavioral difference does more to secure the retirement than any argument over whether the right fixed number was 4% or 5.5%. This is the point where the entire fixed rate debate quietly changes shape. Every number examined so far, the headline 5.5, the padded down 4, the corrected range between roughly 3.25 and 4.5, shares one silent assumption: the withdrawal is fixed, set on day one, adjusted only for inflation, and then followed off a cliff if the market refuses to cooperate. That assumption is what makes the whole exercise so brutal, because it forces the arithmetic to survive the worst cohort while spending exactly as if it were the best. Watch what the fixed rule did to the 1966 retiree. Stocks went nowhere for a decade, inflation more than doubled prices, and the model kept ratcheting the dollar withdrawal upward into a shrinking portfolio because the rule said to. The withdrawal climbed precisely when the portfolio could least afford it. That is not a market failure. It is a rule failure, a schedule that refuses to notice the emergency it is living through. Now give that same 1966 retiree one modest permission: cut spending when the portfolio is clearly in trouble. Do not hold the inflation raise in a year the balance drops sharply. Trim the real withdrawal a little when the account falls below a threshold, and restore it when the market recovers. This is the family of approaches, sometimes called guardrails, a floor and a ceiling around spending that flex with the portfolio instead of ignoring it. The retiree who does this does not have to survive the worst cohort at full spending. They only have to survive it at reduced spending, during the years that were going to be lean anyway. The consequence is larger than it sounds. A retiree willing to absorb a temporary 10 to 15% cut in bad years can start meaningfully higher than a fixed-rate retiree, because the plan no longer has to be engineered around the single worst sequence of returns in a century. The 1966 grind stops being a near failure and becomes a stretch of leaner years followed by recovery. The 40-year horizon stops being a threat because the withdrawal shrinks in exactly the decades that threatened it. The frictions still bite, but they bite a moving target that can duck. And here is the truth the fixed-rate debate keeps missing. The most powerful lever in the whole calculation was never the starting percentage. It was flexibility. A retiree with a rigid budget and no room to adjust genuinely faces the harsh math. For them, the corrected range near 4% is the honest read. A retiree with even modest slack, who can defer a raise or trim a discretionary year, is playing a fundamentally easier game and can carry a higher starting rate through the same history. Which reframes everything that came before. The search for the perfect fixed number assumed the retiree was a machine executing a schedule. Real retirees are not machines. They see the balance fall and they respond. The 1966 retiree almost certainly did, cutting spending out of fear the model never recorded. The question was never which fixed rate is correct, it was how much the retiree can flex, and how quickly. Because once spending can bend even slightly to meet the market, the argument over the one true withdrawal rate stops being the argument that matters at all. Ask any honest analyst for the number, and they will not give it to you. They will give you questions instead. How long do you need the money to last? What will you actually pay to hold the portfolio? Can you trim spending in a bad year? Or is every dollar spoken for? What was the market priced at the month you retired? That refusal is not evasion. It is the only intellectually honest answer, and this entire investigation exists to explain why. Look back at what the 5.5% figure survived. It cleared every rolling 30-year cohort since 1926. Depression, war, the 1966 inflation grind, all of it. That record is real. It is not a marketing invention, and it is not the reckless number the 4% camp fears, but it survived only inside a very particular machine. A 60-40 portfolio, rebalanced annually over exactly 30 years, withdrawing from a costless index before $1 of tax, in a world where the retiree never flinched when the balance fell. Change any one of those conditions and the number moves. Stretch the horizon to 40 years for a couple retiring at 60, and it falls. Layer on a single % of fees compounding across decades, and it falls. Pay the tax the index never owed, and it falls. Retire into a market priced well above its long-run median, as today's is, and it falls again. Every honest correction bent the same direction, down, toward a range between roughly 3.25% and 4.5%, depending on whose circumstances you are pricing. And then the reversal that undoes the whole fixed-rate argument. A retiree willing to trim spending in the lean years, to defer an inflation raise, to flex 10% when the portfolio is clearly in trouble, is playing a different game entirely and can carry a higher starting rate through the same brutal history. The most powerful lever was never the percentage, it was how much the human being holding it could bend. So the macro question finally has its answer. Why won't any honest analyst hand you 5.5% as a rule? Not because they are timid, and not because the record is fake. Because a withdrawal rate is not a fact about the market. It is the output of a calculation whose inputs are your inputs, your horizon, your costs, your valuation, your flexibility. The 5.5% record describes a model. It cannot describe your account because it never met you. The moment an analyst hands you a fixed number, they are quietly assuming your life matches the models, and the entire point of this examination is that it almost certainly does not. That is the discipline the number teaches, if you let it. Not 4% chanted like a commandment, not 5.5% waved around like a permission slip. A rate you build, deliberately, from the three conditions doing the heavy lifting: how long the money must last, how much of the ride you can tolerate, and what the market was charging on the day you walked out the door. Name those honestly, and the number falls out of them. Refuse to name them, and no percentage anyone hands you will hold. The record survived every market since 1926. That much is settled. What it cannot tell you is whether it will survive yours, because yours has not finished happening, and the assumptions that carried every past cohort are precisely the ones you get to set or lose. A plan built to last is only as durable as its willingness to bend. This is education, not personalized advice. The record is real. The rule is yours to build, and that is exactly why no one can hand it to you.